Hi everyone, it is Monday the 7th of November, and that means it's time to take a look at what moved the markets last week. It was quite a volatile week given how relaxed the weeks preceding that were, but there was quite a lot going on. So the 1 week return of the NASDAQ 100, as an example, was negative nearly 6% on the week, and the S&P 500 gave a return of nearly 2% for the same period, and we'll talk about why in a moment. Chinese equities rallied very strongly into Friday, but lots of risk-off assets, not all, but lots of them, like the US dollar and bond yields, US bond yields, did quite well through the week, particularly towards the end of the week. Now, one of the biggest things to happen in the week was surely the meeting with Jerome Powell, where they raised the US interest rate by 75 basis points, completely expected. And initially preceding the press conference, the note that was shared seemed quite dovish, but then going into the press conference, Jerome Powell dropped bomb after bomb in terms of hawkish messaging. The initial dovishness was caused by certain paragraphs within the note that were shared ahead of the presser. A quote there being, in determining the pace of future rate increases, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. So the market took this to be dovish because they saw the Fed saying, we recognize that there are lags. The things that we're doing now will have effects quarters, maybe a year beyond this particular moment. So we will be careful in what we're doing. They're no longer on autopilot. They're going to be looking at the data. But then in the press conference, Jerome Powell said things such as, we still have some ways to go, and the incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. I don't think anyone expected that out of the meeting, and there was a very strong and immediate reaction when he made that statement. Another hawkish statement was him saying that he thinks it's very premature to think that there's going to be a pause in the tightening cycle. And I don't think anyone expects the Fed to pause now or at any point this year or even very early next year. I think it's just the fact that he made this very strong, explicit message that really hit the markets. And finally, he also said that if they were to over-tighten, that's okay. He's okay with over-tightening because then they would have tools available in order to support the economy. But if it were to go the other way, if they were to underdo their job, if they were to do too little, there's a chance that inflation would get entrenched, and that would create a much bigger problem, a more difficult problem to deal with. So overall, that meeting was particularly hawkish, and the numbers in various markets definitely show that. As an aside, it does seem as though the market thinks that the Fed's terminal rate is now somewhere north of 5%, just a touch above 5%, meaning that we could be looking at rates of 5.25% towards the middle of last year. Will we get there? Nobody really knows, but at the moment, that's what a decent portion of the market expects. The other major thing moving the market last week was earnings, and if you don't already read it, I highly encourage you to subscribe to FactSet. They put out some really good statistics about various things, including earnings season. So earnings season has been not too bad. It could have been a hell of a lot worse. 85% of the companies in the S&P 500 have reported. 70% of those companies have reported EPS above estimates. But this is below the 5-year and 10-year average. So the numbers are slightly worse than they have been historically, but they're still not awful. The caveat there is that while the numbers on average look good, there are some companies that are reporting awful earnings. Chinese equities had a really good week, especially towards the end of the week, and this was because there was a rumor going around that the government was looking at an end to the zero COVID policy. Now, the government itself has come out twice, I think once on Friday and then again on Saturday, saying there is no immediate change to this policy, despite Beijing coming out and crushing people's hopes that we might see a very sudden, sharp end to the zero COVID policy. I think that we might be in the beginnings of the end. I think it will be a slow process. It probably will take a year for them to work through. But it does seem that there are little pockets of information being leaked out that show that the government's stance towards this policy will begin to shift. I wanted to take some time in today's video to do something a little bit different. I've spoken about this in the abstract. There are a lot of question marks around when will the market go in from being bearish and swivel back to being bullish, and obviously that depends on the macroeconomic picture, and that depends on the Fed, and the Fed in turn is looking at inflation as well as employment and unemployment within the US. Lots of countries around the world, I think, will and have copycatted the US's approach, and so I suspect when the US does change tack, other countries at least will start thinking about shifting from slowing their economies down to supporting growth once again. So the thing that I want to look at in detail, because I suspect that it's widely misunderstood, is the way that the inflation numbers are represented and how inflation will come down and the pace at which inflation will come down. I think it's going to come down a lot quicker than people expect. So the inflation number that we receive and makes all the headlines, so this inflation number that you see on screen, this is for the US. This is a rate. It's a rate of change. And most commonly, there are a number of measures of inflation. I'm going to focus specifically on this one, though. This headline inflation number is the rate of change, the annual rate of change on the basket of goods that's represented within CPI. So the CPI number is a calculation of a basket of goods that is supposed to be representative of things that people within an economy might buy. The inflation rate is the rate at which this basket of goods changes price. So the annual inflation rate is the change in the price of the basket of goods from, let's say, September 2021 through to September 2022. Now, what you can see on screen, based on the numbers published in the US, is that the price of this basket of goods was going up quite rapidly, leading into June this year, at which point it has more or less flattened out through the past 4 readings or so. Now what this means is that if the readings of CPI were to remain, let's say, at the 296 is roughly the level that the last 4 readings have been at, through to June next year, that inflation in June next year would be very close to 0, because the rate of change would be close to 0 because the price hadn't really changed. And the reason that inflation increased quite rapidly is because the CPI number increased quite rapidly over a short period of time. Although, as you can see here, the inflation rate has been dropping off and it seems to be trending down now. What's important to note is that inflation coming down does not mean that things are getting cheaper. What it does mean is that the rate at which things are becoming more expensive is slowing down. It's always a little easier to understand these things when looking at a picture, and so what I have on screen is a spreadsheet. I've pulled the CPI data, the month-on-month CPI data from the US database, and I've calculated the month-on-month inflation as well as the year-on-year inflation. All the numbers in black those are data points that have actually been printed, they exist, and then the numbers in blue are the ones that I have forecast. The point of this exercise, well, there are a few points. The first is to figure out how quickly inflation might fall. The second is trying to figure out when the Fed might pivot. Now, what I've done as part of my forecasting model, in fact, the variable that this all depends on is the month-on-month inflation rate. So the long-term average for month-on-month inflation within the US is 0.19%. So I've rounded that up to about 0.2%. And many economists at the moment think that the average month-on-month inflation that we're going to see for the next 6 to 12 months is going to be between 0.1 and 0.2%. In fact, you can see that for some recent months, these are real data prints, the number has actually been negative. The CPI number has dropped month on month. So if I plug in that number, a 0.2% month-on-month inflation rate from this month roughly to 1 year out, obviously it's not going to be 0.2% every month. These numbers always are a bit chunky, but I suspect that we've got a few more negative prints on the way and maybe a few upside surprises as we go along. And what you get with this assumption is the line in red, and the graph is the inflation rate, year-on-year inflation rate. At the moment, the last print that we saw was this 8.2% print. And if the month-on-month inflation rate continues to be 0.2% on average, then this will drop off quite sharply through the next year. At the same time on this chart, I also have this blue line, and that is the interest rate as set by the Fed. So that has increased quite rapidly through this year, going from 0.25% to 4% right now. And then I kind of have to guess where this interest rate is going to land in the future, because no one knows for certain. There's a little more certainty through this year and early next year, but then beyond Q1 next year, it's a bit of a more hazy picture. However, assuming that we get to roughly 5%, maybe slightly over that, and the Fed holds on, I think that this is quite accurate. It's accurate enough for this exercise. Now, the value of having both of these things on one chart is that quite often, historically speaking, the Fed will want inflation to fall below the interest rates and stay there for a while before they properly pivot. And the pivot in this case is the Fed saying, all right, we're not taking rates any higher for now, and at some point in the near-term future, we're going to start pulling those rates back down to encourage growth within the economy. So I can play around with this assumption. So at the moment, I've got a 0.2% month-on-month inflation rate. I could change it to 0.1%, and then inflation comes down faster. I could take it up to 0.3%, and then inflation becomes a little bit stickier. But long story short, if I keep the month-on-month inflation somewhere between 0.1% and 0.3% per month, then inflation falls below the interest rate somewhere within the time frame of March to June next year. And in my opinion, based on what's happened in the world historically, this feels like it's the most likely window for a Fed pivot given the context that we have today. Now, does this mean that the market is only going to bottom within this particular window? No, that's actually quite unlikely, because the stock market tries to anticipate what is going to happen. The Fed doesn't need to entirely pivot, as we have seen before. The market just needs to think that the Fed is becoming slightly more dovish in order for the market to find its footing and begin to rally. I do think that in order to have sustained bull market return, we probably need to have the Fed pivot properly, but that doesn't mean that the market only begins to pick up once the Fed has actually pivoted. The market will anticipate when this thing is going to happen, and it will start building that in to its pricing of assets before that. In terms of the probabilities that I expect, I think that we may have seen a market bottom and the market chops sideways for a while until we get a bit more certainty, a little bit more optimism from the Fed and other participants in the market. But even if the stock market bottom isn't in just yet, I don't think it is that far away. I think we were much closer to the end of this bear market than we are to the beginning. Just as an aside, and let me zoom in a little bit here, the other thing that the Fed is looking at are the employment numbers, obviously. So inflation needs to come down materially, but also they want to see the employment picture weaken a little bit. And the non-farm payrolls is one piece of data that they are looking at. And the actual numbers keep on coming in slightly higher than the forecast. But what you can see is that the trend is definitely down and to the right. So these are the number of people employed during the previous month. So it does look as though the employment picture for the Fed is going in the right direction. All right, now that we've got a bit of a better understanding of the timeline of inflation, what it is, and when it could start coming down, and to what degree, what's happening this week, well, there's lots to look forward to. We're getting one of those very important inflation numbers out of the US on Thursday, and I think all eyes will be laser focused on this. But of course, we also have the United States midterm elections happening tomorrow. So I expect this week to be highly political, and the headlines will be dominated by this until the event passes. And then we'll have investors, traders, and economists focused on the CPI number. Those aren't the two only major things going on this week. They are pretty major though. Earnings are still going on, but we are most certainly towards the tail end of earnings. Lots of interesting earnings happened for companies within my portfolio last week, and I will put out maybe several posts summarizing my thoughts on the earnings that have come in. There were some good, there were some bad, there were some ugly, and I would like to share my thoughts on those with you. All right, that's it for this week. I'll speak to you soon. Goodbye.